Hello, everybody. Welcome to another episode of Still Searching with Jed Morris. Today, I'm speaking with Caleb Basile. He runs a QoE prep company. So he's doing quality of earnings for business buyers. Thanks for being here, Caleb.
Thanks, Jed. Appreciate the
And did I
invite.
did I pronounce your last name right? I just realized that I
I,
wasn't sure if I
I
did.
wasn't even going to correct you, but it's Basile.
Basile. So that I always ask because I want to make sure that that's done correctly. And I think it really matters. Like I've got one of those first names, Jedediah, where literally no one knows how to pronounce it correctly. And so it's always been kind of a thing for me.
Yeah, you have to be a Star Wars fan to be able to pronounce your name.
Yeah. Well, hey, thanks again for being here. And like I said, you run QoE prep and you do quality of earnings for lower middle market and mid market companies, correct?
Correct.
All right. Well, hey, tell me about kind of how you got into the space and what exactly QoE prep is doing.
Sure. A little background about myself. Just going to turn off the heater. I started in public accounting back in 2017, did a little bit of audits, payroll taxes, CFO services, taxes, just a little bit of everything for small businesses. I got to wear a lot of hats. And from there, I decided I was going to focus on audit and work for Baker Tilly with the goal of becoming an audit partner at Baker Tilly. Within a year of being there, they said, "Hey, we need help with transaction advisory services called the quality of earnings. Do you want to do this?" I said, "I don't know what that is, but I'll give it a shot because I don't really want to do employee benefit plans over the summer." So I joined them, and within a week, they said, "All right, you're going to join us full time on quality of earnings. You're no longer doing audit. We like you. We really like working with you." So I said, "Great. I enjoy the work as well." It's a little bit more fun. You add more value in a QV and saying, "Hey, buyer, you're actually going to buy this for $500,000 less," than when you say, "Hey, you owe $20,000 in taxes. I'm done
Yeah,
with
that's
my work."
definitely much better news to deliver to your client.
Yeah, or like with an audit, like, "Yep, numbers look good." So I don't know. It's just so much more value added in quality of earnings and transaction advisory work than audits. But I did originally start off doing QVs directly for clients. I wanted to stay on the larger deals. So I became a staffing firm, if you will, or a consultant with contractors working with me, all based in USA. And we'd work on these larger deals. And they'd pay us a percentage of their fees, but we'd run point on everything, do everything from beginning to end for them.
Yeah.
After a year of doing that, I decided, all right, I'll do my own deals, and I'd like to stay in the middle market, but I'm also in the lower market as well, doing deals anywhere from 1 million to 50 million in revenue.
Got it. So your bread and butter is kind of in the middle market then. So I imagine independent sponsors are kind of and fund managers, those are kind of like your primary clients, but you also dip down to, financial buyers and first-time buyers who may be looking at the SBA route.
Correct. Yeah, exactly.
Okay, good. Well, that's really interesting because a lot of people that I talk to are, for their first-time buyers, and they're just kind of getting their feet wet with the idea of how to search for a business, how to do due diligence. And one of the biggest I guess gray areas of mystery, especially for first time buyers, is the financial side. Now, we know that finances are only a piece of the deal, but in a lot of ways, they're the foundation for what the deal is on, right? You have to have them there in order to have the deal. And it doesn't mean the deal is going to work, but if the finances don't work, then there's no point in even having this conversation. So as we head into due diligence, that's typically where you bring in somebody to do quality of earnings. So what exactly is the quality of earnings and how do you approach it with your clients?
Good question. So when you sign the LOI, you're on a ticking time clock. You have 60, 90, 45, some amount of days to do all your diligence before you say, "Hey, seller, I'm going to buy the company." Or you say, "Seller, I'm not buying this company." Or you say, "Seller, I'm going to buy it, but can we talk about pricing?" So the main diligence are financial and legal. I try to make my offer where you can do all your financial due diligence before doing legal. So I get it done in 2 weeks. I'm
Two
hammering,
weeks?
yeah, in 2 weeks.
That's amazing. Usually it's like 4 to 5.
Well, 1 week of it is uh, the QB provider. They'll be making sure they're allowed to do this and that there's no conflict of interest. The next week is gathering data, and then I don't know, they're just checking over everything. Or there's backlog log because they have to do a lot of tax reports or a lot
Sure.
of audits as well. But since I'm a QoE specialist, it's the only thing we do. And we could start on day one. And I'll hop on the call with the seller and get all the stuff I need right away. I'm not going to delay.
That makes
Um,
a lot of sense. It's kind of like other businesses, and I know I'm digressing a little bit, but it's kind of like going to like In-N-Out Burger. They only do the burger. There's nothing else there. Now I'm cutting
yeah.
out all the other fluff. Or it's like Chick-fil-A. You're just getting a chicken sandwich. Don't
All
show up
right,
if
I'm
you're looking
hungry
for a
now. I'm
burger.
going to Chick-fil-A after this.
Right? So that makes a lot of sense though, because you're like, hey, I'm not doing all the other fluff. I'm just doing the QV, and as a result, I can give you a better product at a faster turnaround. Speed is
Correct.
everything.
Yeah, yeah. And if a deal dies, I'd say, I don't know if these numbers are right. As a number of guys, I should know. But probably 8 out of 10 times, it's the financial due diligence and not the legal due diligence. What have you seen?
It's the same thing. I mean,
Yeah.
there's been and granted, I'm not on the services side as you, so I see far fewer deals. It's more of me, I'm talking to searchers who have had experiences either buying successfully or backing out, and the vast majority of the time it's the finances that kick you
Yeah.
out. It's waiting to find out if you haven't found anything already that's made you leave the deal. It's the Q of E coming back to either confirm or reject the numbers that you've already assessed. Um, I mean, there's one or two times I have seen one or two times where the legal did ruin it, where it's like there was a minority owner that nobody knew about, or something like
Oh,
that.
yeah.
Like a minority owner who had died a few years back, and now the spouse like legally owned a
Hmm.
piece of the business, and they're just trying to sell it out from under. I've seen that ruin a deal. But you're right. I mean,
And that wasn't
99% of the
caught in
time
the
is
tax returns.
yeah, yeah. I mean, you know how it is. Small business, it's just total mess.
Yeah.
Um, but yeah, I mean that's rare, but you're right. It's almost always the finances that ruin the deal.
Yeah.
Wow. Okay. All right. So you're doing the QV. It's all you're doing. You can return this thing in 2 weeks. But what is the QV? Like I'm a brand new buyer. What the hell is this thing? And why should I pay you whatever your fee is to give
Yeah.
me a QV?
So I'd break it down in three sections, four, I guess. You got the quality of earnings piece, which basically we're looking at what the reported EBITDA is, what the seller's adjustments are, then what our adjustments are, which comes to the adjusted EBITDA amount. The adjusted EBITDA amount is very important because most businesses in the smaller space are going to be a multiple of adjusted EBITDA,
Right.
or seller's discretionary earnings, which add back all the money going to the seller as well. So we help verify that all the seller's adjustments or the broker's adjustments, because the broker's representing the seller, that all their adjustments are operating, reasonable, and that they calculated it right. So the first thing I do in a QV is I'll look at the seller's adjustments. I'll either accept them, deny them, or recalculate. And that right there is going to save you, it's going to help you, it's going to lower the purchase price unless they did it really, really well and
Yeah.
aren't way too optimistic. So the QE is one piece of it. The next piece is the profit and loss analysis. I'll look at the revenue. I'm just doing this in order of my template. I'm not doing it in order that I do the work. Um, but you look at the revenue, the types of revenue, the customer concentration, and the seasonality. And then you got the balance sheet section, which looks at accounts receivables, accounts payables, inventory, net working capital, cash conversion cycle. And then you got the reconciliations. The reconciliations are the first thing I do. It's the first phase. If they don't pass, the deal typically dies, and I'll only charge you half the amount. Some people say, "Oh, you're a
Oh,
QV
okay.
provider. You should charge the full amount no matter what." Because you did a full service. Well, no, I give them a halfway time to like, hey, I'm done with half the work. If you want to leave the deal because they're claiming 1 million in net earnings, but I'm only seeing 700K net earnings, you can leave, and I'll refund you half the amount, or
Yeah.
I won't, or we could roll it to your next deal.
So I'm
And the
going to
recon,
pause right there because that's actually a really great sale to the buyer. Because I've had this conversation a few times, and people ask me, I'm like blanket. I would not buy another business without a QoE. That's my blanket response.
Yeah.
And I understand there's different, revenue levels. If you're buying under $1 million in revenue, there's a risk on. I would still argue that the ROI is there for a QoE. Now,
Oh yeah.
even with that though, like, you always run the risk of dead deal cost. Like, what if I get in there and I pay for this QoE and then it proves that the deal is no good? Well, the truth is that it's still worth my money because you kept me from making a bad deal, but it doesn't change the fact that I now have sunk deal cost. And so what I do personally is I go in there and I'm like, for the first week or two, once we're in due diligence, I'm doing my own financial due diligence where I'm like,
Yeah.
I'm looking for any big red flags as a
Yeah.
non-professional. And if I see a big red flag, then I'm like, okay, now I don't need to pay for it. I'm out, whatever. But if I
Yeah.
don't see any big red flags, then I'm like, okay, let's bring in QoE. And you're kind of doing the same thing. You're like, hey, I'm going to start off with these reconciliations because I know they're important. And once I knock those out of the park, I'm going to give you the results of that. And if it's not, and if this is something like a big red flag, we're like, hey, it's not even worth paying, like going through the rest of this QoE. You're saving me time, so I'm going to save you some money. But it's
Yeah.
up to you as the client.
And the three main reconciliations are financial statements to the bank statements, and then financial statements to tax reports, and the payroll accounts to the payroll reports. Then if they have revenue, like point of sales revenue system, I'll compare that as well to the revenue line item. And then I'll also look into the sellers add backs, all their add backs, to make sure they're reasonable. And then at that point in time, I'll present it to the buyer and say, hey, we're halfway done. Here are the numbers. Here's the variances. Do you want to keep going forward or stop?
That's incredible. So if you can do the whole QoE in 2 weeks, are you saying you can do that, you get the halfway point after 1 week?
Yeah. Yep. At the 1 week. But
That's incredible. That's
typically,
amazing turnaround.
this is when I get the data. So if
Right.
they're not giving me data at all, I can't do anything. I mean,
Okay.
if you're doing a QoE in April, you're going to be delayed because a lot of their external accountants are saying, hey, it's tax season. So there's deals where you won't get anything in April. If you're doing a QoE in January, it's also going to be delayed because of audits. But most other months, you can get the data pretty fast. And if the seller's broker has done a good job, in the perfect world, a broker should never list a company without having everything in my request list, which is pretty basic. It's just reports from QuickBooks, bank statements, and tax reports,
Yep.
payroll reports. That's all. Like that's all you need to have. But it's very rarely that it's there.
Yeah. Okay. So you're doing the reconciliation. You get to that halfway point, and as the buyer, if I'm like, all right, well, big red flags, I don't want to keep going, then I can save some money, you save some time, and we just end it right there. But let's assume that it comes back and everything's looking pretty good. And I'm like, all right, let's keep going. What else are we looking at?
So we're looking at the customer concentration, which is something you could probably do before signing LOI. We'll look at the revenue trends, also something you can do before signing an LOI. There's a lot of stuff people can do by themselves.
Yeah.
The challenge with that is this just confirmation bias? And are you wanting to buy this company so bad that you're ignoring the bad stuff?
Yeah.
It's kind of like I'm really good at numbers and I'm really good at investing. I was fantastic. I won 6 out of 7 years, and by winning I mean beating the S&P 500. I stopped doing it because it took up so much of my time, and because I would get emotional every now and then. And even though I knew the numbers were right and I should have held on, I would sell. So I stopped doing that type of investing, and I just buy like an index fund now, or ETF, to make it much easier, and because there's the emotional piece of it. But when you're buying one company and you're just using yourself, the risk is you might be glossing over stuff that you should be looking into.
Yeah, the risk is enormous. You get that behavioral finance side where you're like, I love this deal, and everything you put on the rose-colored glasses and everything looks great. One of the things I've run into a lot is, as you know, I've been interviewing people for my upcoming book, and we just finished. But in over 75% of those cases, I asked very directly, I'm like, hey, when you finally got to the deal that we're now discussing, and was there buyer fatigue? And they look back and like, yeah, I was searching for 12 months. I was searching for 14 months.
Yeah.
Personal capital was waning. I was really getting stressed out about whether or not I was going to find something. And so that buyer fatigue fed into them putting on their rose-colored glasses and, making some exceptions for the standards that they'd held up until that point. So having somebody like somebody on the outside who can look at it objectively is incredibly valuable, much
Yeah.
less knows what they're looking at.
Yeah, they're too caught up in trying to join your next podcast, done searching, when they have the
Right.
company.
Yeah. I mean, it makes sense, especially as the first time financial buyer. And you're like, you want to get to that ownership level so fast. And I had somebody reach out just yesterday and they're like, I tried searching for a business last year, but I failed. And now I'm trying to, find another one. I'm like, whoa, whoa, whoa. You failed? Yeah, I didn't find anything to buy. I'm like, that's not failing.
Yeah,
Failing is finding a bad business and buying that and being 4 million, in the hole, personally guaranteed. That's failing. Not buying is not failing, which
right.
is exactly what I love about the QoE. So,
Yeah,
and you're right. A lot of these things, you can look at, pre LOI, but it's more the confirmation because,
yeah,
you're trying to figure out, okay, well, I've got all this customer concentration, but based on the invoices and the payments, it could be more severe customer concentration than you thought going into it.
yeah. Or I've seen clients, they'll say they have seven customers in the top 10, but all seven of those customers are the same customer, just in different
Yeah.
locations. So
Yep. Yep.
they'll call it different things in QuickBooks.
Yeah. I saw the same thing last week. Someone bought and they said they knew the number one customer was 30% of revenue, but not until after they bought the company they found out that it was actually 40% because there was a subsidiary also billing.
Gotcha.
Yeah. So yeah, that's an incredibly big risk. So as you're going through these QOVs, and just for context, how many of these deals are you doing every year, like more or less?
So between me doing the deals directly for clients and doing deals like being outsourced to do the work,
Yeah.
last year I did 57.
Wow. 57 QOEs. So it's I mean, you're seeing a lot more of these than I am, that's for sure. And you're seeing a lot more of them than the typical buyer would be. And so with seeing all of these different QVs, what are like the top three like red flags you see like right at the gate? It looks like it happens so often. You're like, yeah, these are the top three things that I just see over and over and over.
So I like to look at the seller's add backs to make sure they're reasonable. A lot of times they'll be adding back stuff that's part of the operating business.
Yeah.
I like to look at customer concentration, vendor concentration, salesman risk concentration. So if it's a
Mm-hmm.
not recurring business, I want to know who's making the sales. Is the owner making the sales and leaving? Um, and then I also like to look at like a variance analysis. So I'll look at every single type of revenue and type of expense and see how it's trending over time. And just anything that jumps out, I'll talk to the owner about.
Okay. That actually makes a lot of sense, especially the salesman part of it, because we know that a lot of project-based work, the owner typically is the number one salesman. Um, I recently spoke with somebody who declared bankruptcy last week, and that was the issue they ran into. They bought a company where, 100% of the sales were coming from two salesmen, split almost 50-50.
Yeah,
And they found out right from the beginning that, the whole company hinged on these two salesmen. And
yeah.
this particular buyer was able to kind of limp by for a few years, but ultimately couldn't hire,
Mhm.
I tried hiring other salesmen, but just couldn't get past that point. So that's an
Yeah.
incredible risk.
Yep. I used to, so my brother is in sales and he golfs and he looks the piece. And me and my younger brother will make fun of him. We're like thinking, oh, salesmen think they deserve all this stuff. But then I started my own firm and realized, yeah, they do deserve it all. It's hard. It is not easy selling. I mean, I'm lucky in that I'm a CPA, so people don't expect me to be like the most extroverted person and like selling like here and there and like helping them with all that stuff. And like my work in Excel will speak for itself, and then you get people selling for me basically.
Yeah.
But I get it. Those salespeople deserve everything. It's hard.
Absolutely. And I've talked to who was that? I was speaking with Nathan Lindley a few weeks ago, and he runs an HVAC. I wouldn't
Okay.
say roll up, more of an aggressive add-on business in Texas. And he was talking about how like when he took over the business, the salesmen were all like they were paid plus commission
Hmm.
and just not bringing in the sales he was looking for. And finally, he's just switched to pure commission and obviously lost the salesman he had and went through a few before he found a good ones. But he was like, but then everything changed like when he found a few salesmen who were just commission only and they were just straight hunters. And he's like these people, I'll give them 20, 30%, whatever the deal is,
Yeah.
because they're just bringing in all that
Yeah.
revenue. And if you're bringing in this revenue, I will happily pay you the
Yeah.
commission fee.
Yeah. Yeah. I was explaining that there's two types of salesmen. You got the hunters that are getting new business, and then the farmers that are keeping the
Yep.
old business. And I can farm. If I have a client, I'll keep them and I'll get them to tell other people about me. As far as like going out looking for new people, that's definitely a challenge for me. So I get why those salespeople need to be paid a lot.
Yeah. Okay. So sales risk makes sense. Um, One of the first things you mentioned was the ad backs. And this is something that a lot of first-time buyers really get tripped up on, whether they're looking at EBITDA or SDE. There's always a seller ad backs. What are some of the most common ad backs that make sense you expect to see? And what are like one or two ad backs that are commonly thrown in there where you're like, yeah, that doesn't pass the test?
Yeah. So not only do we need to make sure that they make sense and are common and are reasonable, we need to make sure that it's in the profit and loss statement. Because sometimes they'll be adding back balance sheet items. So like
Yeah.
there's personal owner draws, and it's something that's not hitting the profit and loss statement at all. It's only hitting the balance sheet, but they're still adding it back. So it's like they're double counting it.
Yeah.
And I'm not saying that the seller doesn't know what they're doing, that the seller's doing it on purpose, or that the broker's doing it on purpose, but it happens and unintentionally because they're not sure what they're doing, or maybe intentionally. I don't know. It happens a lot of times. The owner pay, you add it back, but then you have to add on the QoE due diligence, you got to add a manager pay going forward, or the new owner pay going forward, because just because an owner's leaving, you got to find something to replace their work.
And just on
Um,
that piece, one common thing I've seen is where you get a lot of these trade businesses where the owner is paying themselves directly out of SDE, which makes total sense. But then they usually have like a spouse or somebody else in the family who's running like the books or running
yeah,
like the sales or whatever the case is, and they're not accounted for at all.
yeah,
So you
yeah.
do see that you have to make sure you add their salary back as well.
Yeah, if you got to add back their salary, but then you got to realize, let's say that they're taking care of the books, you got to either hire a manager, a bookkeeper for them going forward, or they have to outsource the bookkeeping to another company. So there's two add backs one going each way, one from the seller, and then the buyer comes in and does their own add back as well.
Yeah. I've also seen one where the seller was using their personal truck as a business truck. And then when they
Mhm.
left, they added back the truck. And I'm like, well, it makes sense. It's your truck. But if you're using it for the business, now the business has essentially lost a truck.
Yeah, yeah. So that's one where it mixes with both the financial piece and the legal piece. Like, okay, what assets are staying with the company? Well, will a new owner need a truck to do business? If the
Yeah.
answer is yes, then I'd probably say keep everything in the P&L. Don't change it to EBITDA, and just say this is part of the purchase price that you're taking the truck away.
Yeah. No, that makes total sense. All right. So with ad backs, what's one or two that you see that are, consistently thrown in there where you're like, nope, got to remove those immediately?
So like increased advertising expense that did not bring in extra revenue. It's a red flag right there. So it's like,
Yeah.
okay, they're trying to make more money. They spend a lot on Facebook or Google or LinkedIn ads or YouTube ads. I've never really spent any money on ads, so I don't really know what people spend. Um, they're like, yeah, we spent all this money on ads and we're not getting any more revenue, so that's non-operational. But if you look at the tax return, advertising and marketing is one of the main. It's just a category. It's not an other expense. It's
Yeah.
part of the operational part of business. Um, or a lot of times I'll see on the buy side. So I do both sell side and buy side, being part of the doing middle market. I'll see buyers try to just add back or like take away one-time revenue.
Yeah.
If I'm representing a seller, I'm like, okay, if you're taking away the one-time revenue, you got to take away the one-time COGS as well to make it fair.
Right.
So just something to think about. Um, Yeah, anything, it's a lot of like non-operating type things, or they'll say it's non-operational, but then I just say, yeah, it's operational, or like a bad hire. A lot of time people will try to add back a bad hire, like, yeah, this is a bad hire, we had to fire them. And
It's
it's
an
like,
operational cost.
no, like people leave jobs every 2 to 5 years, like it's part of the business. Or consulting fees.
Yeah.
Um,
I've seen that hiring consultants to help you sell the business, and they're like, "Well, we're going to add this back because obviously you're not going to need this consultant going forward." And you're like,
mhm,
"Well, there's a thin line between were they helping me consult the business or were they helping me improve the business, which a lot of
right.
times, building a business and sale is improving the business."
Yeah. Yeah, and sometimes like okay, so like if an owner has expenses for selling a business, like he's paying a broker 10,000 a month to list his company, that's a reasonable add back, because you're not going to be having that listing fees again going forward.
Yeah. All right, let's pull out of the weeds for a second. Okay. I, I love this, by the way, because I think you're kind of shedding some light on kind of the financial due diligence that a lot of buyers, they I feel like most people, you shy away from the things that are uncomfortable. And if you don't know it and it feels uncomfortable and it's hard to learn, then you're just like, well, if I get everything else right, then maybe I can just ignore this piece or hire somebody else to do it.
Yeah.
But what I've found is that, when it's the financials, even the legal, like you have to find people who are doing this stuff that are better than you. Like I'm always going to reach out to somebody like you who does QoE as opposed to just trusting in myself to do it because I'm not an expert. But at the
Yeah.
same time, you have to know enough about the process to A, be able to vet the
Mhm.
professional that you're hiring, and B, being able to question what they're coming up with. Otherwise,
Yeah.
you're not really taking ownership because at the end of the day, you're going to get your fee, but as the buyer, I'm the one signing on the purchase agreement. So
Right.
it's all on me at the end of the day. So taking a step back, out of the weeds of it, is there any circumstance, and I know you're biased on this, but is there any circumstance where you'd imagine like a QoE may not be required? Like you would have ever advised a buyer to move forward with that one?
It's hard to tell because you don't know what you don't know. So like I've worked on like a small deal. The buyer's like, yeah, this isn't really that important, but I'm just doing it to check the box. And let's just say my services added a lot more than checking the box
Mhm.
because there's a lot of expenses. Very rarely you'll see someone overpaying in taxes, but he was missing a lot of expenses on his tax report and on his financial statement. I found it doing the proof of cash. So there's a lot more money running, leaving the business in the bank statements that I could see than what was being reported in the financial statements.
Yeah.
It ended with the seller firing his accountant. So not it was not my goal to get people fired.
Right, but you're finding the problems.
Yeah, I found that the huge problem of it. And he was overpaying in taxes too, which is kind of funny.
Oof.
You
Oof.
rarely see that people overpaying in taxes.
Yeah. Yeah, I'm sure he wasn't happy about that. It's like the
He
last thing
wasn't
you
like,
want to overpay in.
yeah.
Well, and then beyond that, you mentioned earlier about how, you know, uh, if you go into into due diligence and you believe EBITDA to be 1 million, and then after QV you find out that EBITDA is 700,000, right?
Mhm.
And some people are like, okay, great, you saved me 300 grand, but that's actually not true because
It's a
we're buying
multiple.
based on the multiple.
Yeah.
So if I'm buying based on what a 4x, you just saved me
Mhm.
what $12 million.
Yeah, I think it would be 1.2 million.
Yeah, yeah, exactly.
Um, yeah, I think, yeah,
Wow.
that's why I need me.
Well, and it also gives you the like it's okay if the numbers are off a little bit and you come
Yeah,
back and you still like the business, but then with that third party QV, now I can actually approach the seller and renegotiate in good faith as opposed to
yeah,
just trying to
yeah.
trying to do something else with it.
And so here's the challenge. Like, okay, you feel a good price amount that you're going to buy. You go to the seller, and they might say, well, you know what? I had another buyer interested. I'm not interested in working with you anymore. So I feel for some reason, like businesses are really overpriced right now because the economy is great. In some areas, it's really good. There's so many buyers wanting to buy companies. The SBA loan allows for like anyone to buy a company almost,
Yeah,
like if you have
yeah,
decent credit and some cash. Um, and now private equity is buying the smaller businesses as well. So more buyers drives up competition. Every single company is going to be worth more.
Right.
in some ways. But I mean, you can compare it to like the stock market, the big blue chip companies, you're paying 20, 30, 40x
Yeah.
earnings. For these guys, you're just paying 45, 6, 7. You're not paying as much as the other ones, maybe 2, 3x earnings. Really depends on the business
True, but
industry
the
you're
risk is
selling.
much higher though. I mean,
Yeah,
if I'm buying GM at 14x or whatever their earnings happens to be, I think they're only trading at like 8 or something. But even then, if like, there's very little likelihood that they're going to go out of business next year, right?
yeah.
Whereas like a small business, I mean, you can get
Not
wiped
sure
out
how
pretty
tariffs will
quickly.
hit them, but I guess we'll see.
Right. Well, that's a whole different conversation, which may change by tomorrow. Who knows, like
Yeah,
how
I
this is
mean,
going.
you look at what happened last week, stock market went down then right back up. So we'll see what happens.
Yeah. And when you're doing your QoE, obviously you're looking at all the history. You're going through like revenues, and not just revenues, but quality of revenues, quality of of customer dilution, all this kind of stuff. By doing all that, do you provide any forward leading projections, or do you just kind of hand over the guidance to the buyer and say, hey, now you can go talk to a fractional CFO about forward leading projections?
Yeah, so the QVs typically you buy a company and what it made last year, not what it'll make next year.
Right.
However, if you're a strategic buyer, you can kind of like see what the trends are. How much has it gone up in revenue year over year? What are the fixed costs that are going to remain the same year over year? What are the variable costs that will go up as revenue go up? And you can see what the numbers will look like. As far as projections, I can help, but I'll have the disclaimer of we're using the assumptions of the buyer.
Right.
So I can help build that for a buyer.
You just made a comment there that reminded me. Obviously, some businesses are more capex heavy than others.
Yeah.
Like, it's a big difference buying a commercial landscaping firm as opposed to a property management HOA company. And so, as you're going through the Q of E, what are you, what if anything are you doing to kind of highlight businesses that are heavy capex? Like, what the cost of that capex may be. Like, there's a big difference between buying a business where all their vehicle fleet is 2 years old as opposed to 12.
Yeah. Yeah. So when it's higher capex, I'll a lot of times say right below EBITDA, like, hey, these are the EBITDA amounts, but here's what they paid in the last 3 years on average for capital expenditures or
Yeah.
maintenance capex, which doesn't really make sense to me, but that's a term.
Right.
Maintenance capital expenditures. Sounds like to me it's just a maintenance and repairs expense, but it's the way people are making a company worth more.
Yep.
So I'll just include that there so they're aware of it, how much extra cash they'll need to maintain the stuff
Yeah, that
or to
also
buy
helps.
new stuff.
That also really helps the buyer see that if the seller has been neglecting their capex expenditures for the last 12 to 24 months because they're
Hmm.
trying not to spend money on it.
Yep. Or you gotta look at accounts payable as well,
Yeah.
AP aging. If there's stuff over 90 days towards the end, like people are like, hey, let me slam the new buyer with all this stuff I haven't paid yet. And that's what
Yep.
the networking capital, adjusted networking capital peg help you find out. So as a buyer, you want to buy a company and you want it to have money coming in and what they owe in the current assets compared to current liabilities. You want it to be at a good amount. You don't want it to be like you have no accounts receivable, no money coming in,
Yeah.
or none of these like little liabilities they have to pay.
I love that. And this is exactly why I want to have this conversation. Um, People who see me on LinkedIn, they see that like one of the biggest things I harp on is the cash conversion cycle. Like, you have to know how long
Yeah,
it takes for you from the moment you make a sale to get through accounts receivable, through all the way through your operations, all the way through accounts payable. Like, how long is that? And obviously that influences net working capital. But that cycle, I mean, the longer it is, especially on the front end, the more risky the company. And
correct.
so I think, and I tell buyers all the time, I'm like, look, the people you're buying from, 9 times out of 10, they're not super financially sophisticated. They're not doing like 5-year
Yep.
leveraged buyout projections or any of this other crap, but they know where all their dollars are. They know exactly where their cash is, i.e., they understand the cash conversion cycle for their business. And if you don't understand that, then you're walking into disaster. And so I talk about this, but I have this unique opportunity to talk to a professional about this. So talk to us and explain the cash conversion cycle and why it's so important.
Yeah, so basically it's a formula that looks at the total sales divided by, I think I'm getting this right, I could be getting it wrong. It's basically a formula between sales and accounts receivable, and it makes sure like how long it's taking you to collect. So if total sales are 1 million, accounts receivables at 250K, your cash conversion cycle is 90 days for the accounts receivable piece. And then
Yeah.
you look at the same thing for AP and cost of goods sold. And then you can also look at the same thing for inventory and cost of goods sold as well. And it just tells you how long it should take you to get the money. Another piece that I like to look at that can help out with this for the buyer is the seasonality of the business. So I'll look at I look at it by month, but then I also look at each quarter and just to show what percentage of revenue is made in quarter 1, 2, 3, and 4. And if it's over
Yeah.
30% or under 20%, it's just something that a buyer needs to be realized when they're buying a company.
Yeah, I saw you post on LinkedIn either yesterday or something, but you were going through this construction company, and you're talking about the seasonality of it. And part of the work in the business I used to own was landscape construction. So I totally get where you're coming from, where it's like, you have these projects, and it's not just the accounts receivable. It's how much of that project has been completed, how much has been accurately billed for. Like,
Yeah,
this is so important, and a lot of people are just skipping right over it. And I don't want people, especially people who are like looking at like HVAC companies or whatever, and thinking, oh, I don't have projects, so I can ignore this. But this is really important. Like, how are we adjusting for the amount of money that you're receiving, and is it
hmm
is it accurate?
Yep. Yeah. If you're buying a company where projects take a month or longer, you really need to look at their work in progress and ask the sellers, can I have your work in progress or percent of completion reports? They call it different things, but they're basically the same thing. And if they don't have it on a monthly basis, you got to really look into their numbers.
Yeah.
Look at their profit margin percentages. Make sure the profit margin percentages are staying pretty even month over month.
Yeah.
But yeah, that's what that video was about. Making sure that the financial statements are showing money when earned, not when billed.
Yeah. Exactly. When earned, because you can't pay payroll with accounts receivable. You have to pay
Right.
it with cold hard cash.
Yeah.
And it's not just when you've made the sale or when you've earned the cash. It's like when you earn it, how fast do you get it? I mean, it really makes a difference if you're billing out all this cash on these larger projects or even smaller ones, and your customers are there's a difference between they're paying via ACH or they're just physically mailing you a check. Like, how
Right.
long is that going to take to arrive? And there's so many of these details that you really have to know. And that's, I know we're in the weeds, but this is why it's so important to talk to a professional, because these are the questions that buyers don't know how to ask. And for those of you who are listening and you're enjoying this conversation, I just want to say, like, today we're really going through kind of like a high level view of a QoE, what it is, how we're looking at it. But we're gonna have a follow-on conversation where we actually do a case study on this, so you can actually see what it looks like practically, and how Caleb walks through his decisions, which is just incredible. Like, until you see it, it's hard to really grasp the amount of detailed work that goes into it. And the biggest takeaway for me is, like, when you actually see it, you'll stop thinking that you don't need it, that you can just do it yourself.
Yeah. Yeah. There's a lot of formulas.
Yeah, and not just, I mean, yes, there's a lot of formulas, and I'm not an Excel guru, so I don't even want to try to do that. But the biggest thing is, like with everything, uh, you can't answer the questions you don't know to ask. Like,
Right.
how many people right there probably didn't know to ask, okay, well, how I'm gonna put the formula together for cash conversion cycle, and how does that impact net working capital? Because it's one thing to say, all right, well, if I'm gonna take like all the cash, and this is something I hear a lot, I'm gonna take all your bank statements for the last 12 months, and I'm gonna average them together, and whatever the average is for over 60 days is your net working capital. Like, that's a pretty risky way to go about it, because you don't know how long it takes for your inventory to liquidate. You don't know how long it takes for your accounts receivable to come in. Like, you may get an estimate for net working capital, and all of a sudden it's gone within the next 2 weeks, and now you're stuck. And without cash, you're insolvent.
Yeah.
Incredible. All right. Well, hey, Caleb, this has been fantastic. Like I said, we're gonna bring you on for part two of this, where we actually do a legit case study on this. Before I let you go, what watch are you wearing?
Oh, it's a Garmin. I love running.
Yes, that's why
Yeah,
I asked. Yeah, Garmin
nice.
Phoenix 6.
What's your mine's a 255. What's your workout method of choice?
I just like the long, slow distance run.
Awesome. That's what I
Yep.
do.
I've taken a break on it recently, but every time I notice, it's like I tell people, I'm like, look, if you're in the Garmin group, you know, and
You
if you're not,
know.
you don't understand.
Yeah, yeah. I have so many like I don't know. I feel like I get a lot of leads from Strava because I'm on
Yeah.
Strava as well,
Yeah.
or
People see
just
you're
people
running on
that run.
Strava.
Yeah.
I, awesome. All right. Well, hey, thanks again for being here, Caleb. Always excited to meet another runner, especially somebody who is a pro at QoE and can really help break it down for us. So again, thanks again, and we'll see you on part 2 so we can go through the case study.
Hang on, I gotta show you my Boston. There you go. There's my Boston medal.
Yes. Wow. All right. You ran Boston. So, okay. All right. Before we break, so what's the goal for this year?
Oh, this year, I mean, I'm running daily, so I'm at a like 610 running day streak. I would just like to do a faster 5K. I want to get under an 18-minute 5K.
There you go. What's your all-time record for the 5K?
I did like a 17:30 in college.
That's booking. That's
Thank
moving.
you. Thank you.
All right, very cool. Well, thanks again for being here, Caleb. Looking forward to part 2.
Sounds good. See you.